Have you ever heard of a market maker? Maybe not, right? But we got a great question on our Facebook page the other day asking us about a really pretty good question when you think about it. And that was, what happens if you couldn't sell your stocks that you own today because the markets suddenly fell quickly or the pricing had gotten really bad? There was this feeling of sort of almost panic in a sense. I thought, you know what, this is a great opportunity to talk about some of the fundamentals of how the markets work. And I'm talking specifically about the stock markets right now, but certainly this exists both from a Forex perspective as well and many others. So let's back up a little bit. You go out and you buy some shares of company ABC for $100 a share. You're very happy to get them. This is a company you've been wanting to invest in. But some news comes out and suddenly the price has a huge drop. Let's say it's 10% and drops down to $90 a share. So you think like, I made a mistake. I want to get rid of this stock as quick as possible. But what if there's no one on the other side who wants to buy it for $90? That would be a huge problem. You'd essentially be stuck in an illiquid asset that you can't get rid of and would really put you in a bad position. And this would lead to a lot of inefficiencies in the market where people are just sitting on bad money that they don't want, and they end up having to do drastic things to get rid of it. So in comes the idea of a market maker. So a market maker is typically a firm or a broker that works within the stock exchanges that does two things primarily. They provide liquidity to the market. And what this means is there's always someone there who will buy what you're selling or typically have shares that you like to buy. Now, in this case, if we can't connect to another human being who wants to buy at the price you're looking for, they typically will always have inventory in the companies that they represent from a market maker perspective. So the idea here is if you're placing a market order, this is an order where you're just accepting the price for what it is right on the spot. So company ABC, I hit buy, and I wanted it at 100, but I got it $100.05. That's a market order. I get it for the going rate. And it's fulfilled typically at the amount of shares I want, barring certain extreme cases. And I don't want to go too into depth into those nuances. I'll do that on another video where we do a deeper dive in sort of the mechanics of the market and what that liquidity looks like. So for the sake of today's conversation, the idea here is these are firms that exist to help make sure that you can buy or sell for the quantity of shares you're looking for on the spot right away. Now you might be thinking to yourself, okay, well, what if I want to buy ABC at 100 and that's it, not a penny more? Well, that's a limit order and something we're certainly happy to talk to at length as well. But a limit order is different. This is where you're asking to fill a price for a certain quantity. Now, this will get filled when there is a market demand at that price. So again, this really comes down to market makers provide liquidity at market-based pricing for the quantities you're looking for. Now, you might be thinking to yourself, well, this is really risky if I'm a market maker. What if that company that suddenly had that huge drop is in really bad shape? Why would they want to hold on to those shares? Well, that's what they sign up for. That's their job. Now, they do make money for doing this, of course. Oftentimes when you're looking at an investment, you'll see something called a bid and an ask spread. This is the difference between what someone is looking for from a buying perspective versus what they'd be willing to sell it for. There's typically a pretty small distance between those two. Now, as the markets become more volatile and prices move in larger swings, that bid-ask spread will oftentimes open up a little bit to provide more of a profit margin for the folks on that, excuse me, market maker team. So I want to wrap this up and keep it pretty short. The idea of a market maker is that there's always someone, in this case a firm, who will provide liquidity to your shares. So no matter what, if you're looking to sell on the spot, there's someone who will be there to buy them. And if you're looking to buy on the spot at the current price, there's someone who will sell you those shares as well. The caveat is if you're doing limit orders, this will not be something that comes into play necessarily. And there are other extremes. I'll give you a couple quick options. If the markets are halted, clearly that stops everyone from buying or selling. And sometimes the bid-ask spread can get so extreme, you might want to check and make sure you're actually giving yourself an opportunity to make the money you think you're making on that sale. Now, most online brokers and discount brokers will show you your estimated earnings when you hit sell, but please, honestly, take the time to check this and be careful. So that's really what we had for today. We're going to go over a number of topics over the coming months and weeks here, or weeks and months perhaps. So, if you like what you're hearing and you want to learn more, please hit the subscribe button. Also click the like button for us. That really helps us out and helps the channel to grow. And if you have any ideas for areas of stock market you'd like to learn more about, drop us a line and let us know. Happy to make it for you. Have a good one. Thank you.